So the brief of this afternoon, Neelkanth, is we want to discuss India's place in the world, right? Let me start with this year, 2025. And at least to me, it seemed like there was no place in the world. There was a little bit of a corner that India was pushed into, that we went through this year on the back foot, whether it was to do with the deterioration in the India US relationship, the on again, off again relationship between Prime Minister Modi and President Trump, the many voices in which we expressed our China policy, the economic advisor to the finance ministry saying we should invite more Chinese investment into the country, and the commerce minister saying there's no chance I'm going to allow BYD into India, even if I allow Tesla, right? So many different points of view here, and not just geopolitically or with our neighbors or in the region, but also economically. For a while, it seemed like growth was slowing and that the government was doing nothing about it. So, do you feel like this was the year in which India was cornered and therefore has reacted more than led, with an agenda?
Let me divide it's a very important question. Let me divide the answer into two parts. The first is the external part, second is the internal part. So on the external side, I think it's important to understand that President Trump is an equal opportunity offender. So it's not that he has singled India out to. I just met someone from the Canadian consulate. If you see how badly he's treating his own regulators, his own, the Federal Reserve. So it's not that. I mean, that's just him. It's not really anti-India in that sense. There is so much made out of the headlines generated by the Trump tariffs. I think people forget that for India, the actual economic impact is very, very, very small. Just because tariffs make all the headlines, and now we are seeing finally with the Supreme Court in the US starting to push back against reciprocal tariffs, or that tariffs on the whole starting to get slashed down one after another. It is clear, and you should see in some of the stuff written on the Trump 1 administration, it is not that this is the first time President Trump has tried imposing tariffs. He tried doing that in the first term as well, but there were adults in the room who stopped him from doing that. This is the second time. There is no adult in the room, so the decisions are spilling out over outside the White House, and now they're getting pushed back from the real world. That just one person cannot really reshape how the world trades. So I wouldn't really overemphasize that dimension. As regards, I think the relationship with China, I think we have to get used to the fact that there will be an absence of binaries, meaning that are we friends or are we enemies? Remember, we are both each a sixth of humanity. The example I give is of China and Japan, where despite the horrors of the Second World War, despite all the wars they have fought over the last 1500 years, their trade has gone from $1 billion in 1970 to $400 billion in 2020. 20,000 people cross through aircraft every day. So there is, I think, clearly a geopolitical rivalry. But at the same time, India offers a very large market. China, the cost of funding is at 1.8%, a 10-year bond yield. US is now at 4.12. The Chinese are supremely dominant in many technologies. I think they're way ahead of the US in many of these technologies. I think in the next 5 years, they'll get even more ahead of the US in these technologies. And so if India has to get access to those, it needs to partner with China. So, and different people, if you think about the World Trade Organization ascension decision that happened between China and the US in 2001, there was a divided house on both sides. Some of the Chinese felt the Americans were trying to entrap them. Some of the Americans felt uncertain whether they should give China these exemptions. So when big decisions happen, there will always be multiple opinions. And we have to learn to accept that there will be multiple opinions. 1.4 billion people cannot speak in one voice. And I think the good thing about India is that all of these discussions are happening, that we are collectively going to arrive at whatever is in our best interest.
But Neelkanth, I'm not arguing against the events that have taken place. I get that that is not in our control. I'm talking about our reaction to those events. For the longest while, many other countries have found a way to appease the Trump administration. You may argue that that is not something India wants to do. And then I'd like to question that. Can we be locked out of the world's largest consumer market? My point here simply is this, that we seem to have been taken by surprise. For instance, even the GST rate cuts were not announced as part of any policy decision, though it would have or ideally should have happened that way. They were announced by the Prime Minister very surprisingly on August 15th in an Independence Day speech. My point to you is we are making do, we are reacting, we are not in this with a clear plan or vision. That seems to be the perception. What do you think?
Yeah, so at least on GST, I'm surprised that people were surprised. This was the fact that the compensation cess was going away, the fact that there was a group of ministers which had already recommended that 12% rate should be taken out, was all in the media for months, quarters.
So you're saying India has been well in control of the agenda?
Not in control, but see, this is the world. This is the way the world is. The world in the next 10, 15 years is going to recalibrate to a new reality. So what you see now is that there are multiple rebalancings happening. So on the one hand, the US, which was at one point 40 to 50% of global defense spending, is no longer capable or willing to do that. That's their domestic political reality. The Europeans were, despite being 17% of world GDP, were 40% plus of global social safety spending. I don't think if they have to spend on their own defense, they'll be able to afford that. And there will be a lot of political churn. For the first time in a decade, I have seen a very serious commentator talking about, to save Europe, you may have to destroy the euro. You're talking about such mega changes. If anyone has the ability to sort of think ahead and start planning, I think they're making a mistake. As regards the domestic economy, and I do think that the economy was decelerating through till September, it was a result of simultaneous fiscal and monetary tightening that occurred in FY25. The fiscal was intended. Some part of fiscal was, I think, unintended, but and the monetary was largely unintended. So when those policies were reversed, we are now seeing a very reasonable recovery.
Okay, I'll come back to fiscal and monetary policy. The India-US trade deal. Is it going to happen this week, today, tomorrow, next week, next month?
I wish I knew.
And you sound almost as if we did the right thing by not giving in which case then I want to ask you the question, is it okay to be, for all practical purposes, be locked out of the world's largest consumer market? And what concession should we be willing to make to, sort of get a deal going?
Right. So, Bob Woodward of the Woodward-Bernstein fame has written this book called Fear on the first Trump administration. You know why he calls it fear? Because according to Bob, President Trump thinks that power is exercised through fear. So when you see that becomes the negotiating tactic, the way to negotiate is to not blink. It is very important to understand the object, who in their right minds. So you think about what the US companies are doing. Apple is doubling down on India. Google has just committed $15 billion in a data center in Hyderabad or in Andhra. You are seeing US companies increasing exposure. I mean, I talked to large US fund houses running, $500 billion, $200, $300, $400 billion. They're all looking at areas to invest in India.
Really?
Yes.
Data doesn't seem to suggest. Portfolio investors?
Not portfolio investors.
You're talking about foreign direct investment.
Direct investment, and meaning private equity, venture capital. And they're looking at India because India is the only market in the world where people are getting reasonable exits. And there are structural changes happening here, which, if you look at the financial markets in India, high yield was non-existent in the US till the 1980s, more or less. I mean, it was the boom in private equity, which actually created that asset. So many of the conglomerates of the US, which are today in insurance, in all kinds of fixed income kind of products, were mostly doing equity. In India, that's how all of them have started. Now they're exploring new areas, how the new types of markets will develop. So forget what happens on the financial sector. What I'm saying is that none of this disengagement is visible in the behavior of the large US corporates. And
So you're saying a trade deal doesn't matter, really doesn't matter?
it does matter. I think that
Will it happen this week?
I don't know,
Today?
but I hope it does.
You're in so many different government positions. Surely you have an idea.
No, but what is very clear is that I'm a part-time member.
Today? No.
I'm a part-time member, and my job is to advise, and I stay clear of things which are not public.
Concessions that we make to the US. Are you on board with, let's say, for instance, the entry of GM crops, even if used for, let's say, ethanol or otherwise, other kinds of concessions that the US has been asking for? How far should India go in favor of a trade deal?
Look, there is always a give and take when trade negotiations happen, and if what you are getting in return is worth it, then it is important to give.
Do you have a red line? But you will look at this from the point of view of a chief economist as well, right? So do you have a red line? Do you feel like if we cross this red line, we have given away too much for something that really has no material impact on the economy?
Look, the team that is handling the negotiations is a very capable team. They have all possible, and remember, many of these things are actually not economic; they're political. So the red lines are always political. They're rarely economic. In fact, from the economic perspective, my advice would be to open up. Because with the US, other than in
So lower tariffs significantly on all US
yes, I mean,
goods.
because frankly, we need to reduce the import barriers as much as we can for our exports to become more competitive. It sounds very theoretical in the new world order that seems to be emerging, but I still believe in that because that makes sense. And I believe a number of people in the government believe in that as well, that lower import barriers are actually going to be good for the economy. But at the same time, you cannot be exposing some sectors prematurely to competition. And
Like, I agree.
it could be
You're alluding to stuff, but you're not saying so clearly. It
No,
would
but
be
see,
helpful if you're clear about, like, this is okay, but this is not okay. Wearing your chief economist hat, I
Chief
understand.
Economist of Axis Bank.
Yes, chief economist of Axis
yeah,
Bank hat.
So if you have, for example, so if you don't allow Indian farmers to do GM crops, and then you expose them to competition from imported GM crops, that is being unfair. So you have to combine that, because I still don't understand why we don't allow GM crops. So other than GM cotton, we have nothing, and so I don't understand why we don't have it. And therefore, my advice would be to open up both. That let the Indian farmers use the seeds that they want to, and allow the imports to happen as well. And I think that parts of India can actually, with the most advanced seeds and the most advanced technology, can actually get better yields than even in the US, and therefore they don't need to worry about imports. So believe me, on these things, when we think about the bigger picture in the economy, again, we are getting caught in the same trap that US politicians would like us to think about, that everything is about US trade and US tariffs. To put it in perspective, $85-90 billion of exports to the US, 40-45% is exempt. Of the rest, once the 25%, that extra Russian oil duty goes away, the disadvantage versus competitors is 5%, which is $3 or $4 billion in a $4 trillion economy. I know it is very important for shrimp exporters, for apparel exporters, for gems and jewelry and auto components. But there are many, many more important problems that we need to be paying attention to. All of this fear around services exports slowing down, oh my God, H1B, there is a big problem. In September, our services exports grew 13% year on year in dollar terms. This is despite
That's the GCC sort of
It is
addition to
exactly
ordinary IT services.
yeah, services exports, and this is despite traditional exports slowing down, meaning trade-related exports, insurance, travel and tourism. So modern trade, a modern services trade, would be growing at 18-20% year on year. There is significant demand for grade A real estate on the commercial real estate side coming up. So I think we're just getting, it is the job of a politician to drive the headlines. I think the media sometimes get caught, like Cecil the Lion story, if you remember. Everyone, even New York Times, had to do the Cecil the Lion. I think this is the Cecil the Lion story. I mean, the real story is in the business cycle in India on how the reversal of monetary tightening is actually now driving, and the end of the hard fiscal tightening phase is actually driving a cyclical recovery in the Indian economy.
Okay, all right. So we'll stop talking about the US, President Trump, and the trade deal. 2026 is almost upon us. What do you think will be India's biggest challenges next year?
Sometime in the next, say, 2 years or 3 years, the US administration is going to realize that tariffs don't work, that just shouting and trying to do basic things doesn't work. All the hard things that need to be done, like easing regulations, building infrastructure, reforming labor laws, getting people used to consuming less, all of those are too hard to do. The simplest thing to do is to devalue the dollar. And when that happens, remember that despite the DXY being at 98, 99 and being down from 110, it is the trade with the real effective exchange rate is still has about 25% more downside if you think about how much it fell in 1971 and 1985. As that process starts, who is it going to fall against becomes a very big question mark. Because as I was telling you, the Europeans really don't want, 81, 85 and 71, the dollar could depreciate against the mark, the Deutsche Mark and the yen, and that was enough. What will happen to the Chinese? And the Chinese real is still falling. The Chinese real effective exchange rate is down 18% in the last 3 years. Chinese inflation is near zero still. So cost of manufacturing and PPI is still negative. So will the Chinese currency be forced to appreciate? If you can't do that, then what will the dollar fall against? And if we get into a period of competitive debasement, remember that we are headed into a regime on exchange rates. See, I'm not talking about the dollar state as the reserve currency. That's not changing for a while. But reserve currency meaning the preferred currency for invoicing. But when you look at exchange rates, we are headed into a territory which we haven't seen since for the last 80 years. So the last comparable period was 1930s, where there was a period of competitive debasement of currencies. Now, how does the rupee and how does the RBI cope with that? So that becomes a very important external challenge. And then we have to also worry about the Chinese overcapacity worsening. They're still doing industrial investments. I know they're trying to correct that, and I think they're serious about it. But I think it's very hard to change that. I used to be a metals analyst. I've seen them trying to control steel overcapacity for 20 years. So it is very hard to do. And that will mean that the dumping from China, how do you cope with that? Where do you draw the line that you allow intermediate goods to get imported, don't get finished goods to get imported? What is defined as intermediate good? What is defined as finished good? So there are lots of these challenges that I think at a policy making level we'll have to get engaged with.
This currency debasement concern that you have, I don't want to say how real it is because I'm not doubting what you're saying, but how likely is it? Are you saying that it's going to happen, it's a matter of time? Or are you saying that it could happen depending on which way the Trump administration policies work out?
Yeah, so see, it is a choice. It is
high likelihood, low likelihood?
No, I think it's a high likelihood. If you're taking this Trump administration, this Trump term till 2028, I think it is a high likelihood. Is it happening in the next 12 months? I'm not so sure. Because see, I have seen or I've read enough of history to see that US presidents try out a few things and then finally kill the dollar. Because that's the easiest to do. because for any economy, see, look at why I'm saying so, and this is not just the chart is here, so it has to come here. I mean, okay, that's also a reason, but that's not the fundamental reason. See, there is something called primary income, which is the income that the country earns on foreign assets minus what it pays on foreign liabilities. Despite having a negative net international investment position, the US had a positive primary income till 2020. Because of the fiscal policies that they adopted after that and the inability to unwind that, what has happened is that their cost of liabilities has gone up, their return on foreign assets is unchanged, and their primary income is now negative. So what used to be supremely positive or very positive is now negative. The equivalent is that you are borrowing to pay interest. And so at some point, this has to correct. Their net international investment position is minus 90% of GDP. The only way countries which run persistent current account deficits and they reach those levels of NIIP is to devalue the currency. Because what happens is your liabilities are in local currency. So suppose the US liabilities are $62 trillion, foreign assets are $34 trillion. In dollars, if you say devalue the dollar by 30%, 34 will become 44. And as the dollar falls, people will dump some US equities, US bonds, 62 becomes 56. Suddenly what is minus 28 becomes minus 12 when you reset the cycle.
Okay.
The Brits have been doing this for 80 years.
So in your assessment, there's a high likelihood of this happening. All right. I want to come back to India. So what should the Indian government be doing to prepare itself, not just reacting like it did this year, but setting the agenda next year? What is left? I hate to use the word reform or the phrase reform agenda, but what is left? We've done the income tax rate cut. We've done the GST rate cut. We now have two very pro-growth oriented regulators in Mumbai, at least, the RBI and the SEBI. And that has been a sea change really in approach, which is very visible in their policy making. What is left for India to do? What do you really think will happen through the course of next year if you had to draw up a list of priorities for the government? Which I suspect you do, but nonetheless.
So the most important thing when you have turbulent seas is to keep your basic things in order. So I think macroeconomic stability has helped us so far. Despite all the turbulence, despite all the increase in US 10-year bond yields and yields in Japan, Europe, and everywhere going up, we are still at 6.48. And I think that in a year's time, we'll be below 6 because the government will stick to its fiscal consolidation path. The demand supply for bonds will continue to push yields lower. So the cost of capital in the economy. See, these are remarkable.
The 10-year rate will be below 6%.
Yes.
By what point next year?
In next 12 months.
Next 12 months.
That's my expectation. And I think the cost of capital for both debt and equity coming down so dramatically is so powerful for Indian entrepreneurs that you've never seen at a non-crisis time cost of fixed capital or cost of debt capital coming down to these levels, while everyone worries about the bubble because everyone is thinking about it as an investor. But if you're an entrepreneur, this is a very low cost of equity capital, and I think this is very attractive. It's creating a whole new ecosystem of equity capital availability of all size and shapes. So you have to keep the economy stable. I think that it has to be the first priority.
So no change in the fiscal consolidation path.
I don't
is what
think
you're
so.
saying.
Yes.
I'm just trying to sort of translate some of this.
Yeah, absolutely.
No change in the fiscal consolidation path.
Correct. You have to be very careful with even the monetary easing. I think this tendency that inflation is 2%, cut more rates, is something that we have to resist. Here I'm being prescriptive. We have seen, think about FY25. We grew at 6.5% despite 130 basis points of fiscal consolidation. 80 basis points was explicit and 0.5 percentage point was the compensation cess, which was collected but not spent. And then if you translate the slowdown in banking credit growth from 16% to 12% from March 24 to March 25, translate that into percentage of GDP, some of it was because of nominal factors, meaning the inflation coming down, but there was also a significant drag on real GDP growth. And therefore, the trend growth. So imagine there's an aircraft flying at say 800 kilometers an hour, but there's a headwind of 100 kilometers an hour. So you're showing as 700, but the moment the headwinds ease, you are starting to fly much faster. And I think that's what's likely to happen. So one of the reasons that the inflation that the GDP growth number is likely to be 7% plus is that I think the pace of fiscal consolidation is going to ease. Monetary expansion has started, so credit growth has started rebounding. I think next year core inflation is also likely to pick up. So far, ex gold, it is still in 3 handle. That's a sign that there is slack in the economy. But as the slack gets captured with this GST cut and then the monetary easing, I think that inflation, the core inflation will pick up. Food inflation has come down too much. Frankly, I got it totally wrong. I expected that food inflation will remain high for longer. It has fallen too much. So my expectation is that it normalizes next year, in which case the headline inflation becomes 4% plus. And then you will find that there was no need to cut rates.
Okay, so you're making the case for a pause in the December policy and a continuing pause unless data indicates otherwise.
Yes.
Is that a fair assessment of what you're saying? Okay. I do have a couple of more questions, very quick, rapid fire style questions on the markets, on gold, rates you answered already to some extent, and on the currency. But before that, I want to get from you a sense of the core economic policy of this government. And I'm trying to condense it into 1 or 2 lines, right? Fiscal consolidation has been at the core of their program over the last 10, 12 years. Excellent work. Like you said, it's held us by, in difficult times. The rest of it has been somewhat industrial policy led. But now industrial policy has become a common thing across the world. So I'm just curious, how do you see not the fiscal policy of this government, but the economic policy of this government going forward over the next 2 or 3 years? What do you think the highlights will be?
So the priority today is deregulation, ease of doing business. So and don't just look at the central government, look at the state governments as well. You just compile the list of things that we've been running through what the states have announced this year. 7 states of India have announced policies which allow women to work the night shift. And this is not just for manufacturing, for services. So if you want to run modern trade, shops that run till 10, 11 p.m., you have to allow women to work beyond 7 p.m. Every single state seems to be, every large Indian state seems to be, creating white lists for industries which don't need to seek XYZ approvals because these are not necessary for that. So the compliance burden is being slashed. The 2 central government committees that are working are also focusing on that. You should expect to see the outcomes of, from what I gather, those meetings are happening really frequently. So there's a sense of urgency. And some of those announcements could start coming in sooner than you expect. And those will be a huge booster. They will not be the headline grabbing, politically challenging and contested things, but from the environment in which businesses operate, I think these will be, so these I think will be the priorities for the government going forward. Industrial policy, remember, India does not have the fiscal space to do what China does or the US does. So far, I think our policy, there may be a new semiconductor policy, which is what everyone has been expecting, that the first fund is over, maybe the second fund will be created. Execution of the existing PLI schemes, I think, will work. Beyond that, and this is again prescription, and I would say this is wishful thinking, which is that the government should fortify its own balance sheet because whatever is happening today in the world is not going to end in the next 6 months. You will see China gaining global share of manufacturing for at least the next 5-7 years before the reversal starts, and a lot of dumping. They're really doing very well on many hard technology sides, and so the government also, from the perspective of access to materials, access to technology, needs to have a fortified balance sheet. And Meaning,
What does that mean, a fortified balance sheet? Like,
so right now there is a, so they're on the back foot, that
they are on the back foot.
on the debt to GDP side, right? So because and I think this is the right thing. India is the only large economy in the world which has done fiscal consolidation, and is still
We
doing
are
so.
moving to a debt to GDP target as opposed to a fiscal
Yes,
deficit
yes,
target.
yes,
Right?
yes, we have.
So okay, yeah. So I mean,
But the point is that when this 60% target was given for general government debt in 2016, uh, pre-COVID we were at 72% or so, but then during COVID we went to 90%. We're now at 80, so we need to bring it down. But the moment you bring in the PSU ownership that the government has,
right.
the fact that they own stakes in steel plants and iron ore mines and oil and gas companies and all of that, that value itself is like 15% of GDP. And so the moment you have access to those assets, uh, swapping, so you sell your iron ore assets and you buy a lithium mine, you sell this, you buy some rare earths. I think the ability of the government to intervene in some of these critical supply chains where the Indian private sector may not be fully capable is very important. So this is why I said it's a wishful thinking that we consolidate.
What are the three things they should do? Because fortified balance sheet can mean many different things to many people. What if you had to recommend? What are the three things they should do?
Consolidate government holdings, which are currently split across various ministries.
So like this sovereign wealth fund model that has been discussed now for almost a decade, right? Where you
Yes.
bring together,
Correct.
all of the government corporate
Government
ownership.
holdings into
Okay.
one centrally managed fund. You
Okay.
can manage it more tactically.
Then second,
I think the government also needs to increase credit guarantee support for MSMEs,
okay, so support small
smaller entrepreneurs and
okay.
all of that.
Third,
I think the allocation for urban infrastructure, so the Urban Challenge Fund that was launched last year, and then last year's budget, about 1 trillion rupees to be spent over 5 years. We'll have to see how well it is running and what are the challenges coming up, because there's always a learning curve. When you launch a scheme, you have to recalibrate it. So once the recalibration is done, to push through a lot more funds through that
for infrastructure building.
for urban infrastructure building.
All right. Okay.
Because what I think is very important for everyone, all of us to understand, is that as much as the Trump administration will try to grab the headlines, it is important for us to understand that at whatever time this 4 trillion economy becomes a 20 trillion economy, it could take X number of years. The extra 16 trillion, not more than 1 trillion will come from a change in net exports. So 15 trillion will have to be from domestic demand. And a large part of that domestic demand will be on stuff which is needed for Indians. And a meaningful part of that will be housing and urban infrastructure. So if you think about capital stock creation, I think the analysts, the media, policymakers, everyone seems to be obsessed with just one type of capital stock, which is the manufacturing capital stock. What they forget is that a very large part of capital stock in any economy is a housing stock and also the infrastructure stock.
So you're very bullish on construction, generally speaking.
Yes.
Right. All right. Okay. Now, in the interest of time, I have 2 or 3 very quick questions. You already answered my interest rate question. What about the rupee? I mean, the RBI has been actively intervening in this market. Do you think that's a good thing? Do you think it's a futile effort beyond a point?
No,
what's your take on where the rupee will be in 2026?
See, I think RBI has learned its lessons. I think the pegging it at 83 was a mistake. They've learned that lesson. You see $33 billion of the intervention that happened between August and October. 24 billion was just taking delivery of the forward shorts they had accumulated last year. So it's like past sins that are coming to haunt you. And so once that roll has happened, or once the delivery has happened, I think the overhang goes down. On a basic balance of payments, because of the exits we are seeing from VCPs, there will still be a few quarters where you will see foreign
90?
firms.
On the rupee?
But I think the desire will be to
we
maintain.
should prepare for a 90 handle on the rupee?
It's like, if your target inflation is 4%, the world is targeting 2%, China is at 0, it'll be silly if you try to hold on to nominal anchors. And but on the other hand, if you look at the real effective exchange rate, Because India's inflation in the last 1 year has been so low, the rear has actually corrected to a very nice level now. So the economic compulsion to weaken the rupee to make it more competitive is no longer there, and therefore a more gradual depreciation would be the right way.
Okay, markets. Are you disappointed with the underperformance of the Indian equity markets this year? And if it were to continue, given some of the volatility you yourself have described, we should be prepared for next year, do you feel it will slowly start to impinge on the one big pillar that's held up this market, which is domestic flows?
No, I'm not disappointed. I expected it. I've been expecting this time correction for a while.
How long will it continue?
Um,
Since you got it right with the expectation.
so you get it wrong, you get it right in market forecast. You hit and miss. So, but I think that in the next 12 months, the 12-month forward earnings will start to rise because as the economic recovery comes in. Remember that in the last 12 months, India is among the worst markets in terms of earnings revisions. So we saw a 12% cut in earnings, which is among the worst in large markets. And as a result, the market remained stagnant. Everyone else went up 20%. We were still stagnant. Then our weights in various benchmarks fell. A lot of passive funds had to then pull out of India. So all of that has happened, but that's behind us. As the economic recovery starts to come in, and when I was in the US and UK meeting investors, I was shocked to see that the short-term investors were calling India an AI loser and Taiwan and Korea the AI winner, and therefore, India is a funding short. That you short, you get the money and you invest somewhere else. And so I think that will start to change as the roots of the economic recovery start to show up, or at least the momentum becomes more visible, and people realize that the improvement in October and so far in November was not just because of GST, and it's going to last. As that starts to become more convincing, I think foreigners, at least on a relative basis, will start to come back. But the tricky thing here is supply. So we think that last year demand and supply were kind of matched, about 6 trillion rupees each. This year, again, like October last year, we've seen a flood of supply. It disturbs the market, meaning, but it's a healthy correction, meaning that, if your forward earnings start growing, keep rising, the headline indices stay in the same range, maybe go up a bit from here, your forward P multiples come down. I think it's very healthy. And so I expect that there will be significant supply. In fact, there's some very big IPOs planned for next year.
I was just going to add to that, saying next year we will see at least two large mega IPOs. Right?
And some of those IPOs, without naming them, I think we'll also see strategic interest, meaning they will also be accompanied by foreign capital coming in. So I'm not too worried about the aggregate demand supply because of those two big ones. But I think the balancing of demand supply. So there is so much supply now coming in, which tells you that these P multiples are very attractive for people to sell.
You're saying we're at the turning point. That's your assessment.
Yes.
That growth, generally macro growth is improving from here on. Earnings is improving from here on. Hopefully the trade deal will get done today or this week or next month, even if it has a non-material impact on growth. And you feel like though supply will sustain over next year, this is enough of a turning point for foreign investors to come back.
Yes.
And that will be the next leg of growth for this.
Yeah, but the RARA...
By when next year? Do you have a date?
No. So the RARA bull markets, I think, will be some time away. Because see, what we have now seen...
What is a RARA bull market?
Because,
right now, we are amongst the worst performers in the world, right?
But yeah, we have not seen a correction. So if you talk to...
time correction, as you pointed out.
Yeah, time correction is different from a fund manager. The people who joined in the last decade and haven't seen a down year. So, you have to go through a phase where you worry about your job. I mean, that hasn't happened so far.
So when you come back next year in December for the next Bloomberg subscriber event, we will be in a RARA bull market?
It is possible.
It is possible.
It is possible because I think
that is as committal an answer I can get from you on something like this.
Because the conviction in India's trend growth will be much stronger at that time. I think by then, this fertile ground created by low cost of debt capital, low cost of equity capital, easing of regulations would have triggered much more visible evidence. Right now, the evidence is there, but you have to work hard to look at it, to find it. But there'll be visible evidence of firms growing, new firms forming, the hardware supply chain, hardware tech supply chain accelerating. There'll be lots of things that are happening, which will, I think, which will make us a lot more positive than we are right now.